Imagine waking up one day, logging into your investment account, and your hard-earned retirement account is just gone. You call for customer support, but all you get is hold music. Turns out your brokerage, one of the biggest names like Schwab, Fidelity, or Vanguard, just collapsed. Sounds terrifying, right? But what actually happens in this situation? Does your money disappear? Do you get it back? And how much of it? Let's break it down in simple terms, no confusing financial jargon. But before we dive in, please hit the subscribe button. It only takes a second of your time and it helps me fight the YouTube algorithm that refuses to acknowledge my existence.
Acknowledge me.
Okay. So what happens to your investment if a brokerage collapses? First thing first, when you invest through a brokerage, your stocks, bonds, ETF, and mutual funds are not actually owned by that brokerage firm. They are held separately in custodial accounts. That means even if the brokerage vanishes, your investments, they don't. Let's say I run an investment firm and business is not doing well and I'm losing money and struggling to pay my employees. Now, no matter how bad things get, I legally cannot touch investors' money and cover my expenses. That money is completely separate and it belongs to investors, not the firm. So you may have often heard people saying BlackRock and Vanguard, they own the entire market because they manage $17 trillion worth of assets. It sounds like they are the ultimate money overlords, right? But in reality, they don't own that $17 trillion. It belongs to individual investors like you and me. They're just managing it. They're deciding where to invest and taking a small commissions for doing so. And that's how they run their business. Similarly, when you invest through a brokerage, your money is not their money. It's yours. It's just held separately. Now, even if the brokerage collapses, your investments don't disappear. They're just moved to another firm. Now, I want to hear your thoughts. Do you think firms like Vanguard and BlackRock have too much power because they control $17 trillion worth of assets? Why or why not? Let me know what you think. Now, there are two main scenarios. Number one is if a firm like Schwab, Fidelity, or Vanguard fails in their own business and goes bankrupt, your stocks, bonds, or funds, they stay safe. In this case, another firm steps in and your investments simply get transferred. Kind of like switching banks. Now, the second scenario is if the brokerage engages in fraud and your assets went missing. Now, this is where things get messy. If a firm illegally misuses client's firm, recovering your money can take time. There is this thing called SIPC protection. SIPC stands for Securities Investor Protection Corporation, and it covers up to $500,000 per account, including up to $250,000 in cash. But if you had more money than that and it was just sitting in one account and it went missing due to fraud, SIPC would only guarantee up to $500,000. The rest would have to be recovered through lawsuits, bankruptcy claims, or government intervention. Now, owning shares in these companies is not the same as investing through them. When you invest through a brokerage like Vanguard, Schwab, or Fidelity, they are just managing your money and placing in different assets or investments. You still own those assets. But when you buy shares of the brokerage itself or maybe an investment company like BlackRock, you're investing in their business. If that business goes bankrupt, your shares could become worthless, just like any other failed company. And yes, this has happened before. Here are two famous cases. Number one is Lehman Brothers. In 2008, the company collapsed. But investors with stocks and bonds, they had their money transferred to other firms. However, people who owned Lehman's own stock, well, that became worthless because the company just went bankrupt. The second case was MF Global in 2011. This firm misused clients' funds. 1.6 billion went missing. I mean, it's in the name. MF Global, come on. Many investors eventually got most of their money back, but it took years of legal fights, and it's just horrible for someone to go through this. So I want to ask you this, do you trust the financial system or do you think it's just rigged for the wealthy? Let's have a discussion about that in the comments. So how to protect your investments? Even though a collapse is unlikely, it's always smart to prepare for the worst. Here's what you can do. Number one, diversify across multiple brokerages. Instead of keeping all your money in one place, you can split it. For example, you can put 50% in one and 50% in another, or maybe 30, 40, 30. In this case, if one firm goes under, you still have access to rest of your money somewhere else. Number two is don't keep too much cash into one account. Since SIPC only covers up to $250,000 in cash, don't let large amounts sit idle. You can use the FDIC or CDIC insured accounts or invest the extra cash in money market funds. Money market funds invest in low-risk debt securities like treasury bills, corporate bonds, and municipal debt. Number 3 is stick to reputable, well-regulated firms. Choose brokerages with strong compliance records and private insurance beyond SIPC limit. Because do you think $500,000 coverage is enough in today's world, especially for someone's entire retirement fund who probably had like millions of dollars? Let me know your thoughts about that. Also, keep an eye on the financial stability of these companies, because just because they are big, it does not mean they're invincible. Anything could happen to any company. So final thoughts: if a major brokerage like Schwab, Fidelity, or Vanguard collapses, your investments are most likely safe. The biggest risks come from the fraud or misuse of funds, in which case SIPC would cover up to $500,000. So if you had more than that, that might be a loss for you. So to be extra safe, subscribe to my channel so that no matter what happens, you won't wake up to a financial horror story one day. And did you know that if you were investing in gold, you might have been doing it wrong? Watch this video to learn the smartest ways to invest in gold to maximize your gains with a lot of added advantages. So let's jump on that one and I'll see you there.